Investment centers in this episode, if you want to call it an episode. Anyway, so what we're going to try to do now is measure the performance of an investment center. And an investment center, as a reminder, going back to the hotel example, an investment center would be the Marriott brand. Okay, it's not just a cost center in the hotel. It's not a revenue center. It's not the profit of a particular hotel. It's a much broader scope of assets, right? So it's the brand Marriott, or it could be a portfolio of Marriott hotels on the West Coast, but it moves beyond the examples of profit centers that we were using in the previous lecture. Okay, so the way that we're going to analyze the performance of an investment center are two ways. We're going to look at return on investment, and we call that ROI, and then residual income. I'm a huge fan of residual income. Okay, investment centers. We have the first approach that we're going to employ is return on investment, and the inputs for the return on investment, which we will see in a second, are income and average assets. Okay, so investment center managers are responsible for revenues and costs and for the investment of operating assets, meaning they're going to go out and acquire assets and put those assets into use, right? So if you're a hotel, maybe you're going to purchase new bedding, right? So new beds, new pillows, new mattresses, and that's going to increase the quality of the experience of guests, and it could lead to higher revenue, higher profits, et cetera, et cetera. But we're essentially using assets in addition to, the day-to-day providing our service. So we have income. We have two divisions in this example. We have an LCD division and a phone division. Okay, I guess we're making TVs and phones. And the LCD division has 750,000 in income, whereas the phone division only has 370. However, the average assets employed within the LCD division are 2.5 million, and in the phone department, 1,850,000. And I shouldn't say phone department, I should say the phone brand. Okay, so now I want to know, is the LCD outperforming the phone? Is the phone outperforming the LCD? How do we go and look at this? So step one, I could use return on investment or what we call ROI. And the formula is going to be income divided by average assets. In this particular example, we said we had 750,000 in income for the LCD department with average assets of 2.5 million. Therefore, we have an ROI of 30%. Then we have 370,000 in income for the phone relative to 1,850,000 in average assets for an ROI of 20%. Two things real fast. First, the formula for average assets is going to be the beginning balance plus the ending balance divided by 2. Okay? So if I have a set of assets, right, and they're constantly depreciating over time, let's say this is 1 year, right? This is my beginning balance. This is my ending balance. And my average would be right there in the middle. Okay? So that's what we're meaning by average assets. It's not the year-end number. It's not the beginning of the year number. It's the average. Second, return on investment. So the LCD division has a 30% return on investment, and the phone has a 20%. Straight off the bat, I would say the LCD department is outperforming the phone, right? It's employing its group of assets in a more substantial way than the phone department. However, right, we could compare the two, but we would also want to go out and compare how are we doing in the LCD division relative to some other player in the LCD division, right? So what if it's the case that all of our competitors, all of our LCD competitors are running at a 35% rate of return? And then what if it's the case that all of our phone competitors are working at a 15% ROI? I would say, okay, yes, I agree that LCD is outperforming phone within our business. However, LCD is underperforming relative to our competitors, whereas phone is outperforming our competitors. So which one really is outperforming? Okay. I will tell you that you probably need to take a whole lot of other classes in order to answer that question properly. You also probably have to work in a profession for 15 or 20 years. Those are really hard questions to answer. And so all we're really doing in this class and in this lecture is learning how to do the calculation. It's like the ground level. And then we'll use or we will interpret the results for the rest of our lives and the conclusions that we draw really hard. Okay. For now, we're just doing the calculations. Second, residual income, right? So what I mean by residual income is essentially how much additional income are we generating over a normal level, right? So are we substantially outperforming what we thought, or are we coming up somewhat short? Okay, but residual income is the measure of additional income that we're earning over and above kind of a normal return. So how do I calculate residual income? I'm going to take the total income and subtract target income. Okay. And for the most part, target income is some percentage of our total assets. Okay. So let's start. Here's our total income. That's a given. We had 750,000 in the LCD business and then 370,000 in the phone business. Then we had 2.5 million in average assets in the LCD division. And we're saying a normal income is about 8% of that. So 8% of 200, 8% of 2.5 million is 200. So what I'm saying in the LCD business is that our income exceeded our target by 550,000. The extent to which we exceed our target is what we refer to as residual income. Okay, we could do the same calculation for the phone, and we could say our average assets for the phone business, 1,850,000, an 8% return off of that is a normal income of 148,000. So we exceeded a normal income by 222,000 in the phone division. All else equal, I'm thinking that the residual income for the LCD business is pretty substantial. But listen, we're outperforming in both situations. And so I think both the LCD and the phone are doing quite well relative to what we expected. One just happens to be doing a little bit better than the other.